Good morning, everyone, and thank you for joining us. Can you believe we're only 98 days away from the end of the year? It's fair to say that 2020 has been a bumpy year, but despite the challenges that we face, life goes on and we must evolve and adapt to the circumstances. Today's seminar is focused on surviving, thriving, and moving forward in today's environment. We have great speakers who are leaders in the manufacturing and distribution industries and who will share their wealth of knowledge and experience to help us better understand where we are now and where these industries are going in the future. My name is Rene Valadez. I am the leader of our manufacturing and distribution segment team at Strothman Company. I would like to thank the members of the manufacturing and distribution team, Wayne Elbert, Irina Morozova, Hamilton Rush, and of course, Ray Strothman. I want to recognize the team's hard work in preparing today's event. I also want to thank our practice growth team, Vince Kane and Jessica England, for helping us with the organization, promotion, and logistics of today's event. Today's seminar qualifies for 2 hours of CPE. Throughout the presentation, we will ask 4 polling questions, and we must receive your responses in order to issue your CPE certificate. You should see the first question on your screen currently. These are pop-up windows, and they will not go away until you provide an answer. If you have any issues responding to our questions, please use the chat function and reach out to Vince Kane. I'd like to respectfully ask that you silence your microphones throughout the presentation, and any questions that you may have for our guest speakers and panelists, please use the chat function and direct those questions to me. We will devote some time at the end of each presentation for questions. Anything that we're not able to address during the seminar, the team will work on following up and providing you an answer afterwards. At this moment, I will turn the microphone over to Ray Strothman, who will present today's agenda and introduce our first guest speaker.
Thank you, Renee. I appreciate your introduction and for arranging this program. We have a really exciting group of speakers today. As you can see on the agenda before you, Ray Aldridge, who I'll introduce here in a minute, will be really giving us just a really great overview of, his company. He'll talk about, how they've gotten to where they are and some of the things that are taking place in their business and how they're moving forward in the future. So I think Ray's a great executive in our community, done an excellent job of leading Orr Corporation to the great success that they've had over the years. Then we have Wayne Elbert, and I'll introduce Wayne a little bit later. He's going to bring us up to date on some of the current issues in tax law. As you know, there's been a number of changes that have taken place as a result of the CARES Act and some other changes. So Wayne's going to bring us up to date on that. We'll have a short break, about 10 minutes, and then we have a panel discussion. And we have 3 panelists, Bryan Eble, John Launius, and Shaun Tanner, and they'll be introduced later. They're all involved in various manufacturing, distribution type businesses, and they'll be talking about this new environment that we're in now and how we're functioning. And one of the things I've noticed is that we have a lot of clients, and a lot of these clients are really doing not only well, but even better than before the pandemic. So, I think it's how you address these issues and how you strategically develop tactics to really succeed in a different and new environment. So finally, Renee, who is on, we have a PPP loan task force. Renee is on that task force, and he is going to talk about the PPP loan forgiveness. There's a lot of companies, originally it was 8 weeks, now it's 24 weeks. So for many companies, that 24 weeks is coming up soon. And Renee's going to talk about the best way to present your application and to make sure that your loan is 100% forgiven. And finally, Renee, then we'll talk about some accounting standards. So with that, I'd like to move on and introduce Ray Aldridge. You know, Ray is he's a good friend as well as a good client. Ray has a really interesting background. I mean, he began his career in aerospace, so he's a high-tech kind of guy. He was with Rockwell International and McDonnell Douglas. He worked on various satellite projects, including the initial launch of something we do every day, the GPS program. So what would we do without GPS today? He left the aerospace industry, went into the power generation industry. He was actually out in California. And when he was recruited in 1993 to join the Oil Corporation, he initially was president. They have a software division, inspection lodging. He was president of that. He then became president of their fire suppression system company, Ore Protection Systems. And finally, he became president of Ore Safety, their distribution, safety distribution division, and CEO of Ore Corp. And he's been with the Ore Corp for 26 plus years, and he continues to serve in that capacity. And Ore Corp is a great company in Louisville that's had significant success, and they reach a lot of industries. And Ray will talk about that later throughout our country. Ray does have a bachelor's in administration from Redlands University and an MBA from Pepperdine University. He's married to Pam. They live in a beautiful home out in the east end of Louisville. And they have, I know Ray, they have a number of children who are adults at this point, and just a great family. So with that, I'd like to turn the program over to Ray, who I'm very interested in hearing his remarks. Thank you very much for joining us today, Ray.
Well, thanks, Ray. That was very kind of you. Let me go ahead and launch my now. Renee, is that up?
Yes. Yes.
Got it. It looks good.
Mm-hmm.
Well, good morning, everyone, and welcome to the Strothman and Company seminar series. These seminars have been a part of Strothman's effort to bring education and connection to businesses and individuals in the Louisville area for as long as I can remember. John Kennedy has been with our account for several years, and Ray Strothman has always offered his assistance. Strothman and Company have many talented and experienced professionals, and we've been fortunate to have such a long-term and valuable relationship with this company. Hope that you're doing well and you will benefit, at least in some small way, from our time here together. That's me. I will start with a brief introduction into Ore Corporation, then move into specific activities in which we have engaged in the past few months in response to the COVID pandemic and how it has impacted our business. I will then address the broader issues of business strategy, and then your need to focus on fundamentals during economically stressed times. I'll briefly touch on the current recession, identifying some attributes that might be of interest to you and to your organization. And during this time, I will provide 2 big tips, recommendations that I think would help you, your business, as they have helped ours. One brief slide introducing our company. Ore Corporation is a privately held business founded in Louisville, Kentucky by Clark Ore Sr. It was started when he began selling gloves out of the trunk of his car. 20 years later, he had a thriving business with 2 branches. His son was just getting involved in the business after attending college and serving time in the military. Unfortunately, Clark Ore Sr. passed unexpectedly, and his son, barely 30 years old, was asked to take control of the business. Clark Ore Jr., he was started, they called him Buddy, and later that was shortened to Bud, stepped into his father's shoes and passionately worked to continue his father's dream. With optimism and a strong work ethic, Bryan brought the business into one of the leading privately held safety distribution companies in the United States. Today, our top 10 customers have combined revenues in excess of $500 billion. Along the way, Bud started Ore Protection Systems, focused on chemical fire suppression in occupied spaces, and such as computer rooms and data centers. Growing quickly, Ore became DuPont's largest purchaser of halon, the dominant suppression agent used for these applications in the country. Installing systems in large data centers, corporate headquarters, telecommunication facilities across the United States, Ore Protection Systems established itself as one of the premier fire suppression companies, and today provides protection for over 25,000 facilities in the United States. Companies like Apple, Microsoft, AT&T, CenturyLink, Coca-Cola, Amazon Web Services, American Stock Exchange, NASDAQ, Yahoo, Google, and other high-tech companies that depend on wired and wireless communications and advanced data processing. In the early 90s, Bud purchased a local organization that provided software compliance for industrial applications. That company, Inspection Logic, has an 80% market share of software compliance addressing fugitive emissions monitoring for the chemical and refinery markets in the United States. After nearly 40 years in which Bud led the company, Bud decided to step away from the CEO position in 2004. And then in 2015, Bud stepped down as chairman of the board, selecting his son, Clark Orr III, as his successor. I was fortunate to start my career in 1993 and was honored to be selected as the CEO in 2004. Today, we have approximately 550 employees, operate 3 distinct businesses, all with a national market. Well, nothing could have prepared us for what happened earlier this year when COVID hit the United States. Within a few weeks, it seems our lives changed drastically. And that is unlikely to return to whatever normal was just a few months ago. That's in itself a staggering thought that our lives could change so quickly and probably forever. One of the biggest challenges we saw when COVID hit was the impact it had on our travel, particularly to our sales organization. It affected our customer-facing activities. From that perspective, our traditional sales organization was pinned down, so we amped up our digital marketing efforts to try and close the gap, focusing on lead generation and connecting marketing campaigns to revenue generation through our CRM. Once COVID hit, we aggressively launched campaigns in ore safety and in ore protections that have resulted in purchase orders nearing $15 million, having generated in the past few months since COVID hit more web sessions, leads, purchase orders than any other similar period of time since we started our digital marketing campaign. Oops, I want to go back. Well, I'm not going to try. So of our 3 companies, Ore Safety was hit the hardest due to the slowdown and shutdown of many facilities and construction projects that drove our traditional revenue. Ore Safety is a headcount business, and as thousands of employees were furloughed or released, our traditional revenue softened. However, leveraging our strong relationship with the Asian markets, we connected successfully and executed on significant opportunities to bring COVID-specific PPE, personal protective equipment, such as masks, gowns, sanitizers, and surgical gowns into the United States. Our strong and well-developed relationships in the Asian manufacturing markets were instrumental in getting products sourced, but even more importantly, getting the products through customs, as China was intentionally holding US-bound COVID products in customs as retaliation to President Trump's decision to unofficially rename the coronavirus to the China virus. Getting product out of China was incredibly difficult, but we were one of the first companies to receive products through the innovation and craftiness of our Asian partners. When the virus first hit, we were able to get some critical safety items. We decided to initially focus on hospitals and medical facilities before even notifying our industrial customers that we had inventory of the high-end demand N95 masks. We sold millions of masks, first to local hospitals, then to local area hospitals, and then to hospitals throughout the United States, believing that was the right thing to do. We had plenty of surgical masks for our traditional customers, so we did not leave them unprotected. Like Strothman and Company, Ore Protection Systems has engaged in a seminar series for the past 15 years. Before COVID, we would select between 18 and 20 cities and hold half-day continuing education certified seminars on advancements in fire detection and suppression technologies, changes in NFPA regulations, and other significant developments in the industry. These seminars represented the largest single source of new leads for ore protection systems and have been responsible for millions of dollars of new projects and service opportunities over the years. With in-person seminars no longer a viable option, we quickly pivoted to a virtual conference, a 2-day speaker-heavy, content-rich event that drew in 50% of the total typical number of attendees in our 20-city campaign. Every session was videotaped and will become current content for future blogs and other communications that will hopefully draw in even more new opportunities. Digital marketing was a critical piece for us in closing the gap when our more traditional selling activities were no longer available to us. Today, our travel and face-to-face meetings are about 30% of pre-COVID levels. Home Protection Systems designs and installs sophisticated fire suppression and fire detection systems in both commercial and industrial applications. Site walks are a critical and necessary element to determining the right kind of system and then designing that system as to meet the needs of the customer while addressing the physical characteristics of the application. By connecting with a company called Asensum LLC, an innovative company that has successfully developed a highly accurate and reliable 3D capturing systems, companies can now contract for a 3D drawing of their facilities, and we can get CAD-ready files, allowing our engineering team to make precise and accurate measurements when designing the system. This has been instrumental in affording us the opportunity to review site issues, select the best solutions, and design a system that we know will match hand in glove to the application. We were recently on a Zoom meeting with the chief fire engineer for Apple's 2 largest data centers, together occupying over 1 million square feet, discussing this solution for their needs. This product has been beneficial far beyond fire protection for companies that require constantly updated as-built drawings for their facilities. The good news, that person who was responsible for the facilities at Apple is a prior Ore Protection Systems associate. He was responsible for installing the initial system, which Apple sole sourced to Ore Protection Systems about 6 years ago. We hated to see him leave, but he has been a great advocate for us at Apple. I'd like to move quickly to discuss how to remain focused on core strategies. I believe that during times like these, distractions can more easily veer us off course, and I recommend you revisit and reinforce your company's strategies and tactics, making sure that everyone is on the same page. One of the best books I have ever read on company strategy is this one, The Discipline of Market Leaders by Michael Tracy and Fred Reniersma. I assume that many of you have heard of this book before, but if you have not, then I would highly recommend that you read it. On the slide, which I assume will be made available to you, I have added this YouTube video so that you can watch a 10-minute synopsis of the book. The authors promote the belief that all successful companies can attribute a significant portion of their success to the decision to select and remain focused on one of 3 profit models. You may not have heard of the book, but I suspect that you are familiar with these 3 profit models. The authors are emphatic that you must choose one of these models, and then you must remain totally committed to that model throughout your entire development of strategies and tactics. They insist that you cannot mingle any of these models with each other. It's an all-out commitment because once you choose one of these 3 models, the decisions become exclusive to the others. In essence, you cannot go left and right at the same time. And that is what you'd have to do if you tried to combine models. I agree with their notion, not because we at OR have rigorously devoted ourselves to a single model, but over the years, we've tried to combine models, usually driven by a desire to address divergent customers in our market. Here's an example of 2 companies that have effectively adhered to a single profit model, although they both exist in the same market, and they both understand that there is a wide array of customer segments in their market. The fact is that in both cases, they have decided to focus on a specific customer segment to the exclusion of the others. The company on the left is pursuing a customer intimacy model. At OR, we often use the phrase the concierge model, because we think—
I'm sorry. I believe you have to hit next one more time to see the logos of the companies.
Oh, okay, thanks.
Okay, there you go. Thank you.
The concierge model, which we think it presents a clear understanding when compared to the term customer intimacy. Listed on the left are 7 of the 12 standards that each employee at this company must adhere to do their daily job. It is plain to see the emphasis on customers' experience and the intentionality that the company wants their customers, their employees to have when engaged with their customers. The one on the right is a hotel, but it is focused on a completely different segment of the market. The segment offers value over personal experience. This hotel chain is committed to efficiencies, just as the first one is committed to experience. 2 companies, same market, but each pursuing a different segment of the market, each implementing a different profit model. These models cannot be combined. You cannot have a low-cost concierge model. The Ritz-Carlton would not consider offering a budget-priced room for their more cost-conscientious customers. That is not who they are after, even though the cost-conscientious customer is the biggest segment of the market. By the way, Motel 6 got its name originally from its price. When it started, a room cost $6 a night. Another story about remaining committed to the profit model comes from a book I read about a meeting that occurred at Southwest Airlines. I wish I could remember the name of the book that included the story. So if you happen to know, I would appreciate you telling me because I just can't find it. But the book recounts a recommendation made by one of the senior leaders present at the meeting. That person suggested, due to the longer flights they had just recently started to offer, that the company should consider providing something more substantial than peanuts for the passengers to eat. He made the recommendation that they offer candy bars to their customers. Herb Kelleher immediately objected. He started to explain what it would cost to offer candy bars. That because candy bars would need to be kept cold, both in transit to the plane and while on the plane, it would require expensive refrigeration units, both on and off the plane. Then the extra fuel needed to carry the 125 candy bars, plus the refrigeration unit, the refrigeration equipment necessary to keep them from melting. How about the maintenance of the refrigeration units or the inventory control necessary to ensure that the candy bars were given to the passengers before the product expired? The additional cleanup time needed when the candy bar was dropped into a chair, then melted, or dropped onto the floor. Herb listed several cost-prohibiting reasons why they could not offer candy bars on their flights. When the person who made the suggestion asked Herb what he was going to do about the need to address something more substantial to eat for passengers on their longer flights, he said, okay, we'll give them 2 bags of peanuts. But this is an example of Herb's fanatical adherence to the low-cost producership model. Efficiency wins. The priority mix-up count comes when people making the recommendation fail to understand the priorities of the company. The person who made the recommendation thought that he was addressing an important customer need, something substantial to eat on longer flights. But his mistake was putting that need ahead of the low-cost efficiency model. Customers may want something to eat on longer flights, but the low-cost producership model believes that that customer would prefer a cheaper flight, even if it meant that he or she went hungry during the flight. In 2008, Orr Safety was awarded the safety PPE contract for Southwest Airlines, and we've held it ever since. When it first was awarded to Orr, we were in a conference room in Dallas when Herb Kelleher walked into the room and shook everyone's hand. He said that safety was their highest priority at Southwest Airlines, and he wanted to inform us that we were the company they had selected to partner with. I put this chart together to help our management team address our company's ability to understand the different attributes of each of the profit models. Again, if you're not sure which model you're pursuing, then look at how your company is addressing each of the categories listed on the chart. By answering these questions, you can see what profit model your company is pursuing, even if it doesn't name it that way. The fact is, some companies try to combine profit models to hit a larger customer segment. And if you're doing that and it's not working, you might want to think about looking into the aspects of your strategy. I'm not saying that a company cannot be successful if they intentionally or otherwise try to combine attributes of profit models, but I'm suggesting it's unlikely. Okay, I'm going to move now to the economy. And I would like to tell you what the economy is about ready to, what's it going to do now and what's it doing next. But unfortunately, I'm not an economist, so there's not much help I can offer you or your company at this time. I'm not going to make any predictions as it relates to the economy, but I do have advice, mostly as to where you might want to go to get solid and practical predictions about the economy and how it might affect your business. Harry S. Truman, a man that personified attention to detail, became president of the United States in 1945. He took office just 4 months into Franklin D. Roosevelt's fourth term when FDR died of a hemorrhage. He was known to carry 2 briefcases wherever he went. One was just for his reading materials. He was also known to have a common man's common sense. This one saying, and I've used it 100 times, is one of my favorites. So my number 1 tip of the day is an economic forecasting organization that has an uncanny ability to predict with incredible accuracy major economic indicators, often as far as a year in advance. The name of the company is ITR Economics, and it is owned and operated by twin brothers, Alan and Bryan. I have used this organization for over 15 years, and I can tell you it offers fantastic insight into the economy and how the economy will impact your business. Alan and I have become good friends over the years. And I remember back in 2009-10 timeframes when he was recommending to everyone that they should buy as much real estate as possible. He said, buy real estate. Buy so much real estate you cannot sleep at night. Then take some sleeping pills and buy some more. For most of you, if you can remember what was happening in the real estate market in the 2010 timeframe, and if you happened to buy real estate back then, you probably did very well. MSA is a $1.5 billion instrumentation manufacturer, and North-Safety is a distributor of their products. Bill Lambert is their chairman and CEO, and we were playing golf a few years ago and chatting about business. I started talking about some of ITR's predictions and recommendations to our business, but I didn't mention ITR by name. I wanted him to think that I was really smart. Bill paused, he looked at me and he said, so you know Alan Bolio too. He said that the predictions and some of the recommendations sounded very familiar because he had heard the same advice from Alan as it related to his company, or had just started our relationship with ITR, so I asked him his opinion of the company. He responded by saying, over the years, I have learned to never bet against them. They have a secret sauce, and it's pretty special. So I sincerely recommend that you call them. And I believe you'll be very happy that you did. By coincidence, ITR is conducting a webinar today, 2 o'clock Eastern Standard Time. It's on the real estate industry, and both brothers will be speaking, which is rare. I think it's $125 to attend. And if you want to check out the kind of information this company is capable of providing, then I recommend you sign up and listen. I promise you'll be impressed, even if you're not in the real estate industry. And as this note says, I make nothing off of this recommendation. This is because I think they're just a great company and they offer a great service. ITR has identified 4 different phases that every business will experience. Frankly, every industry is in one of these phases, as is every geographic area of the country, as is your business. But phases don't always align. In fact, they seldom do. As a result, your part of the country may be in one phase, the industry in which you operate in another, and your business still in a third. Each phase has general strategies or tactics to pursue in order to take advantage of opportunities. ITR will tell you what phase your business is in, what phase it will migrate to next. ITR will also tell you what to do to position yourself to maximize the profit potential of each phase, the one that you are in and the one to come. Now, I will tell you what ITR is genuinely saying about the economy today. We're in a recession, but we are already starting to see glimpses of the start of a recovery. By 2021, we will be in recovery, but it will be slow, at least for the first half of 21. It'll pick up steam in the second half of 21. But what they are telling their clients to do today is to prepare for the recovery now. Invest in technology, scalable capacity, and your personnel. Money is cheap, so don't hesitate to borrow if you see a strong ROI as a result. But that is a general assessment. Your mileage may vary. Don't assume that this general forecast applies to your business. If you want to know more, then contact them and they will walk you through the process. I'm jumping around a lot, but I have a short period of time and I want to address the issues that, that I think are important. Now I'm going to talk about the hiring process, and more specifically, the selection process. If you want to read about the selection process, you don't have to look far to find lots of suggestions about what is important in the process. The selection process is a critical one, and you'll find all kinds of information when investigating the subject. But this sets my stage for my second big tip of the seminar. The Handwriting Research Corporation is a must-have in your selection process. Mark Hopper, the founder of HCR, is a graphologist, which is the study of handwriting. My relationship started with HCR in 1996 when I met with the president of a company in a California-based fire protection business. At that time, we did not have a presence in California, so we were not competitors. He told me about the handwriting analysis, about Mark Hopper and HCR, and he said that he would not make a hiring decision without using the company. Frankly, I wasn't too impressed at first, but I agreed to contact Mark Hopper and check out his company. Mark told me to send a sample of my handwriting and he would analyze it for me. If I thought it was accurate, I would pay him. If I thought it wasn't, then I didn't owe him anything. So I sent him my handwriting. I got back a 10-page document that identified characteristics and attributes about me that I had never told anyone and thought that nobody knew. But I did tell him there was a significant mistake. The report identified a weakness in my analysis that I did not possess. The report was wrong. Mark said to me, go home and ask your wife. If she says the report is wrong, then you don't owe me a thing. So I went home and showed the report to my wife. The next day, I sent a check to HRC. If you want to see examples of the report, you can go to HRC. Oops. Go to their website. And on their website, they have dozens of examples of handwriting reports that offer a variety, over a variety of people like politicians, celebrities, and criminals. So why is that important? Mark told me over 20 years ago that people get hired for their resume and fired for their personality. And that's true. Most of the terminations that you have to do or know about were not driven by performance, but by the failure of the person terminated to abide by the ethical, cultural, or company standards. I can't tell you how many times we would get a resume that looked great. We would look at the interview, we would interview the person and think that we'd found a winner, only to send the handwriting to HRC and get the report that told us to run fast in the opposite direction. For an additional fee, you can talk to Mark or a member of his trained staff and they will walk you through the report. I've had some 50 conversations with Mark trying to convince him that the person we had just interviewed was going to be a great hire for the company. But if Mark said no, he never wavered. And every time, without exception, without a single exception, every time we hired against an HRC recommendation, the person was either terminated or left within the first year. Not a single exception to the rule. So today it's a requirement. We have to have a positive result from HRC before we will hire a person. As a disclaimer, the handwriting report will not tell you if they can do their job well. For instance, can they sell? It will not answer that question. It does not evaluate the quality of their performance, but the quality of their character. If I had more time, I could tell you dozens of stories of how we used this report to evaluate the performance of people before we hired them. And I can tell you, they're really amazing. We've offered for our own employees the ability for us to pay for them to have their handwriting assessed, as long as we keep a copy of the report. So far, just a handful of people have selected to do that. They're afraid of what the report will tell us. And again, I don't gain any financial benefit if you contact HRC and start using them. I hope that you do. Mark Hopper has been on virtually every morning show in America. He's been profiled on the front page of Wall Street Journal. And for several years, he was under contract with the FBI to analyze every note left by kidnappers. So when the John Benet Ramsey case was active, he and I had some great conversations about his thoughts although he never violated his confidentiality obligation. Well, that pretty much wraps up the comments that I have for this morning. I appreciate the time that everyone took. I appreciate your patience and attention. And I enjoyed doing this. I'm doing this from, I'm actually officially on vacation down in Florida and with my wife. And, but I enjoyed very much spending some time this morning with you folks. So at this time, Renee, happy to engage in any questions. If anyone has any.
Yes, I have a couple here. The first one has to do with, you mentioned the PPE and how you guys made sure that the right people got it first. So the question is, how important is corporate responsibility in today's world?
Wow. Well, I appreciate the question. We felt very, very compelled to do the right thing. We knew we had a product that was under stress in terms of its availability to the medical community. My daughter-in-law and son are both work at hospitals, and we were just very compelled to make sure that we started with Louisville area hospitals, and we contacted them, contacted hospitals in the state of Kentucky, and then we started just contacting hospitals in general. And we felt as a company very, very fortunate that we were able to help so many people. So I would say corporate responsibility at OR, and I would suggest at your companies, makes the organization feel like what they do is more valuable than profit. You know, what we say about values at OR is values are what you will do instead of making a profit. And we value the ability to serve those who are most in need.
Okay, I have another question, and it has to do with China. You did mention that it was difficult to get some of the product out of China.
Very good.
Is the U.S. too dependent on Chinese products?
Well, the answer is yes, at least from our perspective. I would say that about 95% of what we sell, people wear. So we sell instruments and we sell some other things that people don't wear as clothing, but 95+% of what we sell, people wear. And of that, 98% is delivered from the Asian markets, China primarily, although we do get product from other companies in the Pacific Rim. But most of that comes from China. I will tell you that the reason that most of that product comes from China is because of price. This is it's a very price conscientious business environment today. Price is very, very, very important. A lot of our large customers have been hurt pretty significantly by COVID. Those in the construction industry, those in the rail industry, in the travel industry, transportation, they've all been hurt pretty significantly by COVID. And even though our revenues have remained strong through the process, we were able to make up a lot of loss in our traditional revenue by introducing some COVID-related products. But the focus on price has even intensified during this COVID experience. And we cannot, in the United States, we just can't compete with the manufacturing costs available to the market from products produced in China. So, but I would say we're too dependent, but we're not ready as a country or as a business community to pay the higher prices necessary to move away from China-produced products.
I have one last question, if you don't mind.
Okay.
And this is a personal question. So earlier you mentioned that you guys have been working remotely at your company. Have you had to implement any new policies that were unpopular with your employees, and how did you deal with that?
So none come to mind. I would say the vast majority of our employees, we call associates, are very happy to work from home. We've been monitoring our performance in production, and it is not dropped in any significant way. So we're very pleased about that. We've made allowances for people that come into the building who, we have 22 locations, so some are very small and some are, more significant in size. We've made it available for any associate who cannot work from home. Their just home environment just doesn't accommodate them working from home to come in. We've amped up our training on how to manage remote workforce, how to manage a remote workforce, how to make sure and monitor a remote workforce for our first line supervisors and managers. I don't think of, and the only thing I can say is that we have actually had to ask some associates to restart reporting to the building because their performance on an individual basis wasn't able to keep up. But that's about the only thing that we've done that's probably annoyed a few people. But and it's cost, as I'm sure it's cost you folks, lots of money for us to ensure that we are providing all of the sanitation and cleaning procedures necessary to protect our associates. We have a large distribution business. It's the largest piece. It's the largest portion of our business, and we have to protect the folks in our distribution centers, or we're in trouble. So we really, so we had to segment pieces of the building or parts of the buildings where we have distribution centers combined with office space to ensure that the folks from the office did not go into the warehouse and vice versa. Different entries, different restrooms, different other facilities that they would be allowed to use so as to never cross-contaminate. We have a safety director that has been working with all of our facilities to identify these procedures and institute them. So it's been interesting. It's been an experience. But I would say, that most of our associates are very pleased. We actually conducted a kind of a, forget what they call it, but it's a survey. We do them kind of periodically throughout the years anyway, but we'll do 2 or 3 a year. We just recently did one where we really addressed how our associates were responding to COVID and how we were helping them. And we got some very, very, very favorable responses. So COVID has not hurt us, but it has changed us.
Right.
Yeah. Okay. Thank you.
Yeah, Ray Strothman here. I had a question. Obviously, your warehouse people cannot work from home, so I assume they're all coming through. And your office people working from home. What are your salespeople doing? Are they still calling on the customers? Or I think you said earlier you only had 30% of the in-person contact you had before. How do you stay in contact with all of your customer base?
So I sent an email out about a month ago, actually right after you and I had lunch. And I asked about 15, 20 of our top salespeople, I asked you, what are your COVID moves? What are you doing during COVID that's helping you maintain your relationships and keep your sales activities high? Again, our sales activities have, on the surface have been strong through the process, but by account, they have varied, in some cases quite significantly. And all I can tell you, like I said, we're about 30% traveling compared to what we used to do in terms of face-to-face meetings. A lot of our salespeople aren't ready to travel. They just don't feel comfortable traveling, and we would never ask them to do that if they're not comfortable. A lot of our customers aren't interested in receiving visitors. So, a part of it is just, from that perspective, I want to accommodate both our associates and our customers. So I asked them for their top 3 recommendations, and I will tell you all 3 of them surrounded enhanced communications through non-face-to-face channels. So a lot more phone calls, a lot more email communications. And I didn't see a silver bullet, but what I saw was a lot of intentional effort to amp up non-face-to-face communication channels.
That sounds great. And I assume you're using telephone, emails, text, and Zoom.
Yeah, we use Teams, but yeah, we use, and it's been, fortunately for us, well, as with a lot of companies, we didn't anticipate this pandemic and the impact it would have on our workforce, but we were ready for it by means of having given all of our associates the ability to work from home long before this happened. So when that occurred, as with most companies today, we were able to fluidly just move into this new sort of environment with minimal impact on technology. Everything was already sort of in place. So like most companies, that was not very difficult for us to transition to. But it was, a challenge for us to make sure that we were doing everything we could to communicate with our customers and our suppliers, so we didn't want to lose touch. Well, Ray and everybody, thank you very much for allowing me to spend some time with you this morning. Just a quick note before we leave. I got fired from my first marriage about 15 years ago, 20 years ago. And then I met this very, very lovely lady who ultimately I married. Our first date, my wife was named Pam. Our first date was dinner with Ray and Carolyn Strothman. That was our first date.
Right.
And apparently they're good at that because we ended up getting married. So we appreciate Ray and Carolyn.
Well, that was a great evening. We met at Stony River, and I think it. You were trying to make her feel comfortable, so I think it worked. Worked. So well, thank you, Ray. You did a great job.
I'm going to go ahead and leave. We've got some things planned today, but I really do appreciate spending time with everyone today, and I hope I was able to help you in any way. Please feel free to call me at any time if you have any questions about anything I said.
We will, and thank you, Ray, for taking time out of your vacation.
All right. Cheers, everyone.
Give Pam our regards, and we will see you soon. Take care.
Thanks, everyone. Take care.
Get it. So I would ask you to join me in giving a round of applause, but I see we can't do that on Zoom. So we're going to move on to our next section, and I have the pleasure of introducing one of the important people, not only on our manufacturing and distribution seminar team, but also on our manufacturing distribution team, but also on our tax team. And that is Wayne Eble. Wayne's a CPA. He is a senior tax manager. Wayne has a lot of experience, not only in public accounting, but also in industry. At one time, Wayne was a controller, and you're saying, oh yeah, well that's pretty normal. But Wayne was actually an air traffic controller, so that is unusual. So he's got a very background and does a great job and works with a lot of our entrepreneurial business clients and has a wealth of experience. So Wayne is going to make a presentation to us now and give us a tax update. So Wayne.
Okay, thank you, Ray. Let me see if I can get the screen up here where it's supposed to be.
While you do that, Wayne, I just want to remind everyone the second polling question should have popped up about a minute ago.
Okay, is my screen up there where it should be now?
Yes.
Okay, okay, there we go. Thank you, Ray. I appreciate the kind words. And people always ask me, they say, you went into one stressful job to another one. And well, it was just the right move to make at the time. And I'm happy I did it. I enjoy what I do. I enjoy working with Ray and the people down there. And these are truly different times we live in. And you just got to rely on some higher authorities to see us through this. But anyway, with that being said, we're just going to do a quick review of the Paycheck Protection Program, just some of the changes that went through it, and some of the tax implications from loan forgiveness, which I believe Renee will address a little bit later on, the latest on the loan forgiveness program and everything. There's still the option out there for payroll tax payment extensions for employers on their portion of taxes and everything. We'll look at that. A couple of the credits that are available. There's been a lot of changes in the net operating loss rules over the past 3 or 4 years, and COVID, brought another change to it, which was beneficial, we believe, to some of our clients. As always, if you're in the manufacturing segment, research and development credit is something that you seriously need to look at, as I believe most manufacturers should be eligible to claim some of that. Then we'll get into a couple of the other changes that came about last year in taxes. First of all, when the Paycheck Protection Program loan program came in existence, it looked at a covered period where you could get a loan which could possibly be fully forgiven, depending on how the money was spent. And when it initially came out, it said that you had to spend 75% of your proceeds on payroll costs and the other 25% on other eligible costs. And at the time it first came out, they set what they call an 8-week covered period during which you could spend this money, and that will subsequently change. I'll get to that on the next slide. To get full forgiveness, you had to meet the 75% of the cost proceeds being spent on payroll. And if you didn't do that, then you jeopardized that some of the loan would not be forgiven. And then there were also a couple other caveats that could reduce the loan forgiveness, that being the number of full-time employees you kept and or the wages that were being paid. Initially, when the loans came out, they were set up for 2-year paybacks with 1% interest. Well, then on June 5th, the Flexibility Act came out and made changes, and it extended the covered period to 24 weeks. It now said that you only had to spend 60% on payroll instead of 75%. And it extended the payback period to 5 years versus 2. The rate stayed at 1%. It did allow, though, that had your loan been originated prior to June 5th under the old CARES Act, that you could opt into the 24-week covered period. And that seems to be a viable option for some people, depending on your situation. And it also extended what were considered safe harbors under the old, under the original rules, where you could restore employees or restore wages by June 30th. Well, it extended that period until June 30 or December 31st of the year. And like I say, Renee will discuss the actual loan forgiveness process and the latest on that. But one of the things that you do need to keep in mind that if you're going to get loan forgiveness, if you submit your application for loan forgiveness within 10 months of the end of the covered period, then the only payments you're going to be responsible for are going to be those which are not going to be forgiven. And of course, you'll pay interest on those. That's pretty much the bulk of that. Now, one of the things they look at when they're talking about loan forgiveness is going to be, hold on a second here, that when you are using the compensation numbers for loan forgiveness, it's going to include gross compensation before any deductions, and it includes your tips, commissions, bonus, and hazard pay, and that does not, and it does include health and retirement compensation. And then for the non-payroll costs, it's your rent, mortgages, utilities, interest, and other non-payroll costs. And then one thing, when you get into getting the amounts of forgiveness forgiven, when they look at the reduction in wages, it's only the reductions over 25% that factor into the equation. If you're looking at reduction in workforce, they do it on what they consider full-time employees. And once again, if you rehire within the allotted time, then you can get out of that reduction. And then there are also provisions that even if you don't restore some of the employees, if you can prove that you've made an effort to hire the employees and you've just not been able to do it, you may be able to get out on that safe harbor. And then there's the tax implications of loan forgiveness. You know, Congress has sort of stated that when they did the loan forgiveness, they did not intend for that to be taxable income. And from the income side of it, it seems like that may be true, but unfortunately, the IRS has weighed in and they had a notice out there, 2020-32, and they basically said that, you know, you're allowed to deduct payroll costs and other costs based on Section 162 of the code. However, Section 265 and some regulations say, yeah, but you can't deduct them if it's allocable to any income that is exempt from tax. And if the proceeds you're getting on the loan through forgiveness are not exempt, then you can't deduct the expenses that are paid with that. And that is pretty much where we stand right now. That's codified, like I say, in the code. And there's also case law that has also supported that anytime you get reimbursed for an expense, you don't get to deduct it. So that's pretty much where we stand right now. There will be some issues to be addressed as to the timing of when this is income or non-deductible deductions. You know, right now at the present time, I tend to think when the loan is forgiven, that's when it's going to be recognized for tax purposes. And, you know, that still needs to be worked out, you know, to everybody's satisfaction. But that's a work in progress right now. Another thing that was available with all the COVID legislation is payroll tax payment extensions. Basically what it amounts to, the 6.2% employer match of Social Security, not Medicare, but just Social Security, can be deferred. And it can be deferred, you know, the employer portion all the way up through December 31st of 2020 is eligible. And at that point, whatever has been deferred is due to be paid back 50% on December 31st, 2021, and the remaining 50% on 2022. The periods of eligible for this started on, I believe, March 27th and does run until December 31st. Now, they didn't have the first quarter 941s out in time to make the changes for that. However, that's well past us, so it's not an issue right now. But you will have noticed on page 2 of the 941s, they do have lines in there for you to account for this. It's anticipated the IRS is going to, as each quarter is filed, you'll probably get a notice advising you when the money is due. So you should get one for each quarter that you filed and taken advantage of that. There are a couple new credits that came in. Go ahead.
Wayne, I just want to remind you, we're going to break in a couple of minutes.
Okay.
If that might, thank you.
Okay, I'll fly through there then. You've got a couple credits associated with all this, the employee retention credit. You know, we'll just leave it at that. There are slides here which can be provided if you'd like to see those, or you can give us a call and we can talk about that. There are credits for emergency sick and family leave because of the FFCRA, which came about because of COVID. So these are both COVID related credits and should be looked at the end of the year when we get there. Net operating losses, when CARES Act came out, they basically sort of gave us some relief from the more harsh NOL rules, which came in under the Tax Cuts and Jobs Act. It basically allows people to go back and carry some losses back that were previously unable to be carried back, and also eliminated some of the restrictions on those. This is a real nice chart that basically shows anything in 17 can go back 2 years and forward indefinitely, or for 20 years. But you'll notice that for the years 18, 19, and 20, Any losses that you generate can be carried back 5 years and forward indefinitely. Like I say, prior to CARES, they were under the same rules as, well, they could only be carried forward, and there was a limit of only up to 80% of your income could be offset by that. R&D credit, once again, if you're in manufacturing, there's a real good chance you could take advantage of this. And it's not just, you know, R&D for products, it's R&D for processes. And, you know, they made a law change a couple years ago where they basically eliminated the detriment that you had if you had AMT, and they said it could offset AMT also, so that helped. And then when they reduced the tax rate a couple of years ago, it made it even more attractive to take what they call a 283B election, which is the 280C election, which is instead of taking the full credit, which would require you to not deduct those same expenses as an expense item on the tax return and arriving at taxable income, you could basically reduce the amount of credit you took by 21% and still deduct the expenses. And that works out to much better for everybody involved. So it's highly recommended. First of all, look into the R&D credit, see if you can take it, if you've got anything that qualifies. And if you do, highly recommend you take the 280C, make the 280C election. However, that needs to be done on a timely filed return, including extensions. Looks like I'm out of time. There's a couple other slides here dealing with a couple of the laws last year where CARES Act went in and made some changes to those. So if you got any questions, just let us know. And also one last thing, don't forget about the inventory tax credit on Kentucky. We're in 2019, allow us a 50% credit. It'll be 75% next year, and it'll go to full 100% year after that, the year after that. Sorry, I ran out of time, but if you got any quick questions, let us know, and then we'll let Renee herd us into a break.
Thank you, Wayne, for the update. Yes, feel free to contact Wayne if you want to continue the conversation. We're going to continue our seminar with a panel discussion. We have 3 leaders in the manufacturing industry that will share their experiences on how the industry has adapted to a new environment and the ways we can prepare for future challenges. First, I would like to introduce Bryan Eble. Bryan is the Vice President of Finance and Administration of Canton, which manufactures the finest American oak barrels and oak alternatives for the global wine and spirit industry. Bryan has over 15 years experience in accounting, auditing, and finance. His experience ranges from being the CFO of a large nonprofit and doing financial audits and SOX audits for young brands while traveling the world. He graduated from the University of Louisville with a Master's of Business Administration and Master's in Accountancy, along with a Bachelor in Accountancy. He served as the treasurer of the River City Alumni Club for several years after graduating U of L. Most importantly, Bryan is also a proud father of 2 children, Samuel and Cecilia, and husband to Megan. So welcome, Bryan. Next, John Launius. He is the acting vice president of regional economic development at Greater Louisville, Inc. John oversees GLI's economic development department, which includes business attraction, workforce development, and industry councils, including the Health Enterprise Network, the Advanced Manufacturing and Logistics Network, and the recently launched technology network, TechFirst. John works directly with consultants, community partners, and state, local economic development officials throughout our 15-county bi-state market to strengthen and accelerate regional economic growth. John has been named Business First 20 People to Know in economic development and is a Leadership Louisville Center 2015 and 2018 Bingham Fellow. He serves on the board of directors for Junior Achievement and is the vice chair of the board of directors for the Transportation Authority of River City. He attended South Southeast Missouri State University for undergraduate studies and graduate school at the University of Notre Dame, Mendoza College of Business. And lastly, we have Shaun Tanner. Shaun is the president and CEO of Winston Industries, a chef by trade. Shaun earned degrees in both culinary arts and business management from Johnson & Wales University. He's a veteran of nearly 20 years with Winston Industries and has served in many capacities for the company, including domestic and international sales, division management, and C-suite. Although Winston Industries is a privately held family business, Shaun has the distinction of being the first non-family member to serve as the CEO of in the company's history. While the company had planned for him to assume the CEO position in mid-2020, they decided to expedite the transition once COVID-19 started. And needless to say, his first 6 months in the position have been quite the experience. We'll jump right into our questions. And first of all, I would like to ask Shaun, by the way, the third polling question should have popped up on your screen. Make sure that you provide us with an answer. So Shaun, manufacturers are always seeking ways to innovate and improve processes or products. What would be the most significant thing that your company is now doing better because of COVID-19?
You know, I was thinking about this, and, you know, I believe that the easy answer is you look at technology and how we're using things like Zoom and conference calls. But I think there's a more significant answer, to be real honest. If I look at our company, when COVID started, I was, you know, in a C-suite role, but I had just, you know, I was planning to transition into this one. And in looking at, due to COVID, what we had to focus on first and foremost was communication. So I think the number one thing that we did as an improvement is top-down communication, not just from me, but all levels down. To execute this early on, I think it was the second week of March, we went forward and we started providing weekly communications to every person in the company. And it was a very, very candid communication. We talked about sales, we talked about profitability. We let them know that there was going to be furloughs that were coming, and that the potential of layoffs were highly likely. And we were very, very honest and extremely transparent. And the goal of this was two things. One was to develop a layer of trust with our entire workforce. You know, it's a scary time for sure. So it was an opportunity to channel communication and make it develop trust that the management is trying to do everything that would help them. Also, it eliminated the uncertainties that come. I mean, COVID's been one of those situations where, you know, I think people's mental capacity has been stressed, and therefore the unknown is more scary than the known. So communicating what's coming ahead, what we're even thinking about, has been, you know, I think the biggest thing. Where are we with an employee program? Why are raises suspended? Whatever that is. Now, as time progressed, honestly, you know, we talked early on about PPP and all those implementations, so they knew what was going on. But as time progressed, it got harder to come up with content. You know, there was less exciting things to talk about besides business as normal. So in those occasions, what we did is we relied on communications, still sticking to weekly communications, and just giving them sales updates about what's going on, maybe a specific division that we're working on. Or I would make it very interpersonal in nature. So I think 3 times I've communicated what my most recent Netflix recommendation is, what to binge watch over the weekend. And it really created a dialogue and an opportunity to develop that trust. Now, that said, I think it's really worked on all layers. We're getting ready to start doing one-on-ones and those type of things on a more regular basis. Still, of course, maintaining 6 feet apart. But in doing that, I think we have their trust. What we have to transition to now is the confidence side. So if I look at what I think we've improved as a company, it allowed us to get a more intimate relationship and really prioritize communication. We weren't bad before, but I think we're doing much better now.
Okay. And Bryan, in your situation, what would you say is the one thing that you feel you did better because of the pandemic?
Yeah, sure. First, Renee, thank you for the warm welcome, and appreciate being here. And I'll have to second Shaun's Sorry, there's a bit of feedback. I had to second Shaun's point of view as well, that communication has definitely improved with having locations in California and also here in Lebanon, Kentucky, and being a subsidiary of a French-owned company. The in-person meetings were eliminated, obviously, so we had to heavily rely on communication through technology and quickly adapt to things that weren't the norm for us. So with the communication being enhanced on weekly meetings, constantly focusing on customers' needs besides our own, and being able to quickly evolve and adapt in an environment that was changing every day, frankly. So being a small company allowed us to be nimble and to make quick changes quickly as soon as the laws were passed. Being 100% transparent, fortunately, we were fortunate enough to be deemed a necessary company by the Homeland Security. Luckily for everybody, so the wine will keep flowing and the whiskey. So just being nimble, adapting quickly, and the communication, utilizing technology is probably the two aspects.
Okay, so Bryan mentioned customer needs. So I'm assuming, John, that in your case, I guess the members of GLI would be your customers. So what do you feel you're doing better since the beginning of the pandemic for your customers?
Yeah. Thank you again for the invitation here today. I'll answer that question in a couple of ways. First, obviously, we're the Chamber of Commerce. We're a membership-driven organization, and so we had to take a really early assessment and make some pivoting ourselves in this process, and in our role as the regional chamber and advocate for business. We did very quickly submit recommendations to both Governor Beshear and Holcomb after convening roundtables with different industries and really trying to better understand kind of the needs and concerns of our members and of industry. And what I love about Shaun and Bryan's comments is that, you know, where you can have guidelines and mandates and protocols, you know, what I think we realized in our work and through connecting with our members is just how valuable communication is. And so whether you're the Chamber of Commerce or whether you're a manufacturing organization, you know, your workforce, your vendors, your customers are your priority, and the ability to maintain or reestablish or even enhance those relationships many times are based on some form of communication. And so that is definitely a strategy that we as a chamber took as well. Obviously, not being able to engage with our members in a traditional way, we quickly pivoted over to a virtual kind of engagement format with programming, with sales and sponsorships. And we have made that pivot. I don't know that we'll ever fully go back. It's been a good thing for our organization and created new opportunities for our staff to really envision and how to support and connect with our members. The other thing that I'll quickly mention is our crisis support hub. We also created an online platform recognizing the bi-state nature of our community, the multi-county jurisdictional footprint, and the enormous amount of evolving and updating information and resources was overwhelming, frankly, to many of our members. And so we quickly partnered with the University of Louisville Business School to develop a crisis support hub that is still active today and hosts a range of information and services from PPE supplies and sourcing to best practice recommendations for your operations, financial assistance, information and connection, workforce resources, even supports for families and student learning. So that is a way, but as I hear from Shaun and Bryan and our members, what we realize is that no matter the industry, there's a underlying dynamic that really many of the operations really build from, and that is trust and relationship. relationships. And again, I would just note that for many of our companies that we work with, many of them even identified an indirect benefit was enhanced relationship with their vendors. They needed to better understand their supply chains, what their capacities were, what the interruptions to any timeline or quality dynamics, and to be much more proactive with their with their vendor and customer engagement. And so that communication has had a ripple effect that I think has positively impacted not only GLI, but many businesses and core industries in our region.
Yeah, so you mentioned that in the resource hub, there's resources related to workforce. And Bryan, the question that I have for you is, I know that you have been seeking for a candidate with a significant role in your manufacturing process. And I'm just curious to know, how has the market been in comparison to a year ago?
Yeah, Renee, that's a great question. And I'll answer it with two different aspects. So as you indicated, recently we promoted our QA manager to plant manager, and we had to backfill our quality manager's position recently. And we're actually interviewing the last candidate today. I believe they're actually here in the conference room going through the process. Currently, it's quite easy for that type of role. I think several people in this area have been adversely impacted by the economy or slowdown in the auto manufacturing industry, which there's quite a few plants around this area. So there's quite a few people currently that are searching employment. Now, on the shop floor position, it was quite difficult before the end of July to get people to come in to work, mainly due to the incentive from the federal government on the additional $600 a week unemployment, which frankly, they were able to make more not working than actually coming in and putting in the 40 hours per week. Again, very similar to the QA position, we're finding it quite easy to fill those type of roles now due to that stimulus package running its course at the end of July. Okay,
so you mentioned people being hard to make them come to work, and this question is for you, Shaun. How are you dealing with absenteeism? Where fall is here, and the schools, parents may not be able to send their kids to school, so they may have to stay home. And we have other issues to worry about. So how are you able to deal with the absenteeism when you have to have people on the floor?
It's a great question. I'll go, there's two parts to that. One is how I dealt with absenteeism, and another one is how we're doing it moving forward. As far as how we dealt with it, early on, our number one priority became keeping COVID out of the building. That was absolutely what we prioritized. We were probably excessive in letting people know if you had any symptoms whatsoever, do not come to work. As a result, we suspended our absentee policy. I had a contact from China, and I was lucky I had masks in Winston by mid-March, I think, before masks were even a debate on whether or not people should wear them. So we recognize that if COVID came into the building, there's a potential to get shut down for weeks on end. And so at all costs, we wanted to do that. And even though business was lower, much lower than where it was, similar to Bryan, we're an essential business because we manufacture equipment for the industries that are necessary. And we still had a need to get that output. So what we did is, while business was low, we did not make any cuts to staffing whatsoever. We intentionally tried to maintain an overstaffed presence. And then when we had downtime, we had less attendance, and we had horrible attendance. I think we were running at over 25% absenteeism, and historically we run between 2.5 and 3.5. So when I look at what happened, it was a big impact, and we started doing job shifting. So by example, I had two welders who, were actually two of my better welders, who went and they worked in the assembly line making cabinets. and which I'll say is very hard to train someone when you're wearing a mask and you're standing 6 feet apart. But we prioritized keeping out of the building because we didn't want that nuclear scenario. Now, with overstaffing and job shifting, we understand that absenteeism still was going to be a sacrifice to on-time delivery, and we were okay with that. We understood we had a great customer relationship. Again, communication is, as I think Bryan and John alluded to also, communication was key. So talking to the customers, having them understand, and honestly, most of the customers were really understanding, saying, listen, we're battling with the situation. We're going to get it out. It's going to be a week late. It's going to be a 2-week late. They were okay with it. So fast forward, we actually didn't have anyone with COVID until I think it was mid-July. And so far, knock on wood, we've only had 2 cases. Now, fast forward, we've had the overstaffing has slowly gone away, and it's getting harder to hire. Now, moving forward, what we're going to do is we're planning for flu season, cold season, and all those. We're going to intentionally overstaff as much as we can. I think we're planning on overstaffing by 10 or 15 individuals to allow that breather and buffer room. As it relates to the schooling situation, that's been extremely challenging. We reached out and sent out a communication out to every employee, part of that weekly communication, and said, what can we do creatively to help everyone in that? So we're in the process, and we haven't actually finalized it, but we're in the process of creating an online board forum where people can actually be resources. So, even though I'm now the CEO of the company, honestly, right now, every night, I'm also an algebra teacher. Actually, I'm probably more of an algebra student first and then the teacher. And so I go forward. So we're trying to be as extremely flexible as possible with all of that. We've told every team member, if you have a childcare issue, you will not be terminated under any circumstance. If we have to alter work schedules, anything we have to do, maybe you're a 40-hour employee that can only do 20. We're making those concessions now while overstaffing or trying to overstaff to plan for the future.
So, John, as Shaun is trying to overstaff his operation, and as the health risk associated with the pandemic push more senior employees out of the market, what's GLI doing in terms of workforce development and ensuring that the labor needs of our manufacturers are met?
Yeah, I don't think it would come as a surprise to anyone that, they've probably heard some of the numbers related to the workforce dynamic evolving with advances in technology, AI, machine learning. This was well before COVID. And as I have seen in a couple of areas of the economy, COVID has accelerated some of these already established trends. And one of those is more senior, older workforce exiting the employment realm. And so, we've been working on this for quite some time. We are one of the 3 core partners within the JCPS Academy model. The Academy's model is a project-based learning process in which students are given opportunities and exposed to different career paths, and then follow that trajectory throughout high school, inevitably ending with some certification or degree that can be leveraged for immediate employment and or entry into a post-secondary forum where they've already got some exposure, some knowledge base, and hopefully can reduce the likelihood that they do probably like many of us, which is change degrees multiple times throughout the process. So our role in that, along with JCPS and Kentucky Works, is recruit the companies, onboard them, and provide them opportunities to engage, whether that's mentorship or curriculum development or actually leveraging equipment and investing in the program so that students have hands-on learning opportunities. And so you can tell by the nature of that, that's more of a long-term solution, something that we got involved with several years ago. I believe it was about 3 or 4 years ago when this program started, with just a couple of company partnerships within a couple of schools, including Ford Next Generation Learning. Through our involvement and through the success of that program. We're now over 120 companies that are engaged with the school system. So that's one way that we continue to kind of look into the future. It's obviously more of a proactive, mid to long-term approach. In addition to work with the universities, our technical college, JCTC, we regularly work with them to convene roundtables of our industry leaders so that the academic institutions can hear firsthand what the needs and barriers are of our industry. To shift that a little and to talk about the more immediate, one of the programs that we developed at the onset of the pandemic is the Displaced Worker Initiative. And what we realized, obviously, that employees that were having to furlough or lay off workers, that's not something that anybody wants to do. And so we found those employers very receptive to communicating with us in advance or simultaneously to those layoffs so that we could, at the same time, be working with companies that during this pandemic were actually needing to staff up. And so by connecting those HR groups, we were actually able to capture some of these displaced workers and provide them as resources for current company needs. That program is still living and going. And so we do have a candidate pool of individuals that we offer for those employers that are looking to staff up. And so I think the last thing I want to mention this is obviously with what is happening in our community, there's some racial equity components that we are very deliberately weaving into all of these strategies. And I think the point I want to make here is just that, when you look at workforce engagement participation, when you look at populations that have varying barriers that have historically mitigated their access to some of these opportunities, it can be really motivating. It's going to be challenging, but by figuring out, and there's not going to be a single simple solution, right? It's going to be a lot of very deliberate strategies on behalf of companies, individuals, community partners. But there is a lost economy within some of the workforce capacity that we have not tapped into as a community. And so GLI historically and particularly now is being very deliberate and thoughtful about all of our programs to make sure that we do that through an equity lens as well.
Yeah, and you mentioned GLI working on basically building a pipeline for the future. And one of the things that Bryan, in your business, you have to do is always look at the future. Based on the nature of your product, you have to estimate sales 3 or 4 years down the road. And, with all the uncertainty going around in the last, or currently and in the last few months, how have you managed that uncertainty? How have you dealt with not making overcorrections?
No, it's a very good question, and probably one that's pretty difficult to answer. But as you point out, with our business model, the way we're set up, we probably have the worst inventory turnover that you may lay eyes on. We have staves that will age in our yard up to 5 years. So having 5 years worth of inventory is quite a challenge. There's a bit of latency. Are you still hearing me, Renee?
Yes.
Okay, sorry about that. There's some latency on my end. So despite some of our increase in personal consumption of wine and spirits during the pandemic, COVID has adversely affected the wine and spirit industry, mainly due to restaurant sales. Some vineyards weren't set up to do direct-to-consumer shipments and relied heavily on tasting rooms. So we've seen a decrease in demand of barrels, and it's almost a double whammy with COVID earlier in the year and now with the fires on the West Coast. So having that impact has been pretty tough on us, but we quickly adapted. And one of the ways we quickly adapted was to manage our purchases of raw material. American oak staves. So we're forecasting our sales to slowly rebound next year and to slightly a better year in 2022. So we're just adapting our purchases of the raw material to accordance with our sales forecast. It's not as good as it was last year, but with that being said, we're fairly confident on where we sit. So kind of a synopsis, we're constantly reevaluating the demand of our product on a daily basis. The local economies of South America, South Africa, Australia, Europe, obviously, is a big market for us. So doing the evaluations of the demand in the industry of the wine and spirit industry in those areas help us kind of gauge where we're going to be 3 or 4 years from now, so we can adjust accordingly. So we intentionally probably have a bit too much inventory, a bit of a surplus. Our goal is to have approximately about a year surplus on hand, just to give us the flexibility to adapt if there was a sudden spike in demand in orders coming in 3 or 4 years down the road.
And Shaun, in regards to your strategic goals, is there anything that you have been reassessing internally, or any systems or processes that you are modifying in order to reach your strategic goals? Anything that you were able to work on over the last 3 or 4 months?
I think that, we always reevaluate, COVID or not. I think if you're not reevaluating your processes, you're going the wrong direction. So we are always reevaluating. I think that the biggest thing that we wanted to do strategically that we recognized was a priority now is when we had the absenteeism, we were doing so much job shifting and, new employee training through this process. And we realized that we were really weak from a work instructions and training process side of things. So it was always on our list, but to leverage a little bit of a slow period of time to prioritize that training program so that new employees coming in can go in and they can be successful very early on. So I think that was probably our #1 priority from a strategic side. Also, as it relates to processes, we've looked at technologies that are out there, ERPs and MRP systems and how we utilize them. And, I think our last system we bought in the 90s, and computers have changed just a little bit in the 90s. So with that being said, it's given us an opportunity to rethink how we're going to do our processes moving forward, how we can improve inventory accuracy and those type of things. So in the next 1 year, we're going to be tackling that pretty heavily.
We're running out of time. I do want to give you guys some time to answer at least a couple of questions from the audience. Really quickly, Bryan, we have an audience question asking, could your labor issues or your shortage of labor, could it be remedied by increasing wages?
We're really not experiencing a shortage of labor in the area. Actually, currently it's been quite easily to bring somebody on board, and we're getting flooded with resumes when we do post a position open. But I think the question might be referring to prior to the end of July when there was the incentive.
Yes.
Sure, I guess in theory, we could have increased wages and brought somebody in. But again, we're working in with a model where we have a standard of labor for the products being developed in the manufacturing process. And at the time, with the uncertainty of everything, we really didn't have any positions to fill at the time. So in theory, sure. Yeah, we could have overcame that obstacle by doing just that if we needed to.
Can I jump in on that one real quick?
Yeah, go ahead.
Bryan, if you have extra people, send them our way. What I'll say is, what I've noticed it's really interesting is I think the the mid to higher level jobs, I see exactly what Brian's talking about. I think hiring a quality manager right now would be extraordinarily easy. It seems like that's the first quote fat that people are cutting. When I've looked at our staffing challenges from, and I don't care if it was before July or now, if you're looking at the entry level, we are still having an issue with that. And as it relates to pay, we are evaluating it right now. We've been pretty aggressive over the last couple of years, but even in talking to recruiters or temp agencies, they're saying that there's actually still a shift going on, and that wage desire at the bottom level is increasing. So we're in the position right now where we are evaluating it, and I believe we're going to have to increase it.
John, what's the growth, the economic growth expectation for our region in the next couple of years?
Yeah, I think in the short term, I think, we anticipate our recovery to continue well into 2020. As, this fall is anticipated to likely bring, another spike in infections that will, again, detour some consumer and investor confidence. As a vaccine and warmer weather hopefully brings some welcome relief, I do believe that we can anticipate some increased investment across all of our sectors. I think accelerated investments in AI, technology, machine learning, as I mentioned, are kind of currently being made and accelerated in light of our current, circumstances. And I am an optimist forever, and do believe that will continue to position, our region well into the future, especially when also coupled with, just our very attractive cost of living, cost of doing business. Layer that on top of, how our region has evolved as a logistics sourcing and easy material access. I think that all of our core industries, when you think about logistics, healthcare, manufacturing, business services, these are all growth industries, and I feel our region is well positioned to leverage those national and international investments in those industries. I would just also, again, just kind of note there's a undeniable advantage that our region offers, and that is the UPS advantage. Our manufacturing sector particularly relies on this advantage, and really is a driver for our region. And so to see their ongoing history of and ongoing investments is a lot of confidence to us, because at the end of the day, whether it's a pandemic, a natural disaster, or whatever we get thrown at us next, companies are looking to manage or mitigate their operational risk. And I think mid-sized markets like greater Louisville, because of kind of the living dynamics, the cost dynamics, and then layer that on top of kind of those ongoing operational benefits, UPS, if anything, accelerated during this time. And so I think that's a great advantage that our region offers and provides us a lot of opportunity in the future. But that's got to be married with training of workforce, so that we have a workforce that is ready to learn the skills of tomorrow, and then the skills of the next year, and the next year. We have to develop lifelong learners in order to support those industries.
Okay, well, great. Well, thank you, guys. Bryan, do you have any closing remarks? Anything you want to share with us?
No, again, appreciate the opportunity to come in and talk with you and with everybody. And if anybody ever has any questions, don't ever hesitate to reach out. Okay, thank you, Bryan. Shaun, any parting thoughts?
No, I think I appreciate the opportunity to come on out. It was a good experience. It was great hearing John and Bryan give some insights as well. And we're all going through it together, and we'll get through it. Thank you, Shaun. And John, anything to add?
No, just thank you again for having us. Obviously, we're over here at the chamber. We've got, we scratched the surface on a lot of kind of the benefits and values that we offer. but would love to connect if you'd like to learn a little bit more.
Well, thank you guys. We're going to continue our program. We're a little bit behind. Share my screen. Can everybody see my screen? Can you guys see my presentation? Okay. Well, I'll go through it briefly, quickly. I'm a senior manager at Strothman Company. I've been with the firm almost 9 years. We'll talk some fun facts about the PPP loan, briefly touch on the forgiveness application, the accounting for the loan, and other relief that is available for companies. So out of the 520 or the 525 billion that was, or only $525 billion were issued out of the 659 that were authorized. The average loan was a little over $100,000 for manufacturers. They obtain about 10% of the funds at the national level. Transportation and warehousing obtain about 3%. Kentucky, the loans in Kentucky added up to 5.3 billion. And if you look at the size, there's an overwhelming number of loans lesser than $150,000. And of course, the application period has been closed since August 8th. So the question we got, and we got it early, sometimes the day after people would get their funds, was, when should I apply? Things to consider is the amount of your loan, and you know, the information about the loans is available. I downloaded basically all the information for Kentucky, and would you believe me that there was one loan for $30? So we're expecting that some of the amount, you know, the administrative burden on the government is going to be great. So we're expecting that some of the smaller loans may not even need to apply for forgiveness. Then of course you have to consider the covered period, which Wayne covered. At the beginning we had 8 weeks, then we turned over to, or changed to 24 weeks. And then the last thing is your bank or your lender, are they ready to start accepting your applications? I know I saw some articles where they, some of the national banks were not ready yet to accept applications. And we have two forms, the 3508 EZ and then the 3508. The EZ is for sole proprietors with no employees. And also if basically your business did not change in quantity of employees and their wages. But we at Strothman Company, we have a task force, and we'd be more than happy to walk you through the steps to figure out which form you need to fill out and to ensure that you fill it out correctly. One of the questions early on was, is it based on cash or accrual basis? Well, it's kind of both. So if you paid it during the covered period, it counts. And if you incurred it during the covered period, it counts as long as you pay it during the regular dates. You know, with the extension of the 24 weeks, virtually all of your, or 100% of the loans should be forgivable unless you have significant different or changes in your operations, or you spend the money on expenditures that you shouldn't have. This is some of the information on the loans. You know, the government put that $2 million threshold for, they call it audits, basically just a review from the SBA. So for those that are less than 2 million, it would take 60 days or up to 60 days for the lender to make a decision and then submit it to the SBA, and the SBA could potentially take 90 days. So even if you apply today, or if you already applied maybe last month, there's no guarantee that you're gonna get forgiven before the end of the year. Again, we're hoping that there's going to be no applications required for loans under $150,000, but no guidance has been issued. As far as the accounting, as the end of the year is approaching, you got to close your books. The ICPA has come up with 4 solutions for booking the funds. The first one is a loan until it's paid back or forgiven. The second option follows international auditing standards. It would be an income liability that it gets offset or transferred to revenue as you incur those forgivable expenses. The third option is a FASB model that is refundable advance that is reduced and recognized as the contributions or the conditions of the release are met. And the last one, it follows not-for-profit accounting, which is a gain contingency model. It would be a liability until the contingencies related to the receipt of the assistance are met. Other relief available, Wayne talked about the retention credit, the payroll tax deferment. There's also the economic injury disaster loan, which has been closed since July of 2020, and the largest loan you could get, it was $150,000. There's a Main Street lending. They have various facilities, and this one is geared toward mid-sized and larger companies. And who knows, maybe there's more funding coming our way. So that does it for the payroll protection program. Again, you can reach us at any time and we'll be more than happy to help you with the process. This FASB came out in June. And by the way, our 4 polling questions should be up. So make sure that you respond. So basically what this ASU did was defer the implementation of leases and revenue recognition for anyone that had not implemented. So for revenue from contracts, now the effective date would be years beginning after December 15 of 2019. If you want to early adopt, you can. And then for leases, is now for periods beginning after December 15 of 2020. And again, early adoption is permitted. I had the opportunity to implement revenue recognition and leases early on because client with international operations and under international standards, RevRec was implemented at the beginning of January 1, 2018 period, and leases at the beginning of 2019. I had to do a comparison of both of the standards, GAAP and IFRS, and what I can tell you is there's no significant difference, but I would be more than happy to continue to talk to you, continue this conversation about leases and revenue recognition. Before we end our seminar, and I'm sorry, I want to be respectful of your time. I want to remind you that at Strothman & Company, we help entrepreneurial business grow at every stage, every day. We take pride in being our client's advocate, and we always strive to exceed expectations. Should you have any questions or need any assistance, please contact us. We have a great team of professionals and an excellent technical knowledge and experience. Please keep in mind that we are big enough to handle it, yet small enough to care. Our next seminar will be held on October 29th at 11 a.m. It's called Quality of Earnings in a COVID World, and will be presented by our Strategic Advisory Services Group. I hope that you can join us. I want to thank our guest speakers for participating and sharing their thoughts and experiences. A big thank you to our manufacturing and distribution team and our practice growth team. I hope that you enjoyed our program, and I would like to thank you for believing in our firm, for joining us today, and I hope that you have a good rest of your day. Thank you.